revenue expenditure and capital expenditure. Why this topic? Because it is the most foundational concept, understanding of which is very important for better applying the accounting standards in their professional careers as well. So this is a concept which is being taught right from class 11 and for CA CPT students. Let us first understand what is a revenue expenditure. So those expenditure which are recurring in nature, which are very essential for the running of the business is nothing but revenue expenditure. So these expenditure, the benefit of these expenditure expire within the same period in which it is incurred. So if it is being incurred in this accounting year, then the same year the benefit of which gets ended. Say for example, I spend salary, I spend wages for those who are working. So I need to pay every month. I pay rent. I pay it every month, right? So all these are examples of revenue expenditure because they are very essential for the day-to-day operations of the business. Whereas capital expenditure are those the benefit of which extend for more than one financial year. So those are the capital expenditure. Say I make an investment in a fixed asset, furniture, or I make an investment in the plant and machinery for my factory. So I invest today in this financial year, but the machine is put to use for down next 10 years. So I will get generating revenue from by use of this machinery for next 10 years, which means that this is a capital expenditure because the benefit of it from that machinery is being obtained for the next 10 years till the life of the asset. So in every topic, before proceeding to learning the concept and solving the problems, the fundamental question which we need to ask is why this topic? Why we need to learn this topic? So that is the way I teach. And so now let us stumble upon this question on why to differentiate between revenue and capital expenditure. There are four major reasons or the accounting principles which is being the basis for making this distinction between the revenue expenditure and capital expenditure. First is matching concept, periodicity concept, going concern concept, and the uses of the financial statement, which we also tell it as comparability purpose. So these four are the primary accounting principles which are the base why we need to differentiate between revenue expenditure and capital expenditure. Now let us first further learn on what these concepts mean. Matching concept. So I have taken an example. So you as a student, right, you give exams to perform to show how well you have understood the concepts. You give your exams, right? So in this example, say you have given your mid-year exam and there's an annual exam. So whatever questions you have performed correctly, answered correctly, you are given the marks. So in your mid-year exam, you have scored 75 marks, 75%, okay? And for the wrong answers, you were not given the marks, right? So for the remaining 25 marks, you were not given because you had attempted it or written it wrongly. That's why you were not given for the 25 marks. What happened in your annual exam? You scored 90 marks. That means you wrote only to extent of 10 marks, you wrote it wrongly. The rest were correct, right? So what happens is, if I tell, okay, in your mid-year exam, you lost 25 marks and I am going to adjust that 25 marks against your annual exam. Is that possible? You as a student, won't you be surprised by this? Right, correct. No, that is not at all possible, correct? Similarly, in your mid-year exam, you lost 25 marks and that 25 marks is being adjusted against another student. Is that valid? No, obviously, right? How is that you are the student who has given the wrong answer, so you should only be penalized for the wrong answer. Or the 25 marks should be removed only from your mark sheet, not from some other mark sheet, right? This is the concept, right? So what I'm trying to explain here is this is how matching concept operates. So in matching concept in finance, like in any entity, what does this actually mean is while gauging the performance of an entity for 1 year. The company has generated revenue for 1 year and we adjust the expenditure which has been incurred. But only those expenditure which contributed towards generating this 1 year's revenue, only those expenditures will be considered for calculating your profit. So we need to match the expense which contributed to this revenue. So these expense to be matched against the corresponding revenue. That is what we call it as matching concept. This matching concept is fundamental for any concept in accounting standard. So based on this concept only, the profit for the year itself is being arrived at. Okay. So this is what is the matching concept, due to which we need to differentiate between revenue expenditure and capital expenditure. There are two sister topics which I would say sister principles: going concern and periodicity concept. So what is going concern? It's nothing but whenever an entity is in any organization, any startup is being started, what is the intention? The intention is that this company will continue for indefinite future, right? Nobody opens a business with a projection that it will get shut down in 50 years or 70 years. No, they want to build a legacy. So any company or any entity which is being started would want, the owner would always want or intend to continue it for an indefinite period. So that is a basic fundamental accounting principle as well. And when if an entity is on a going concern, say for indefinite period, at some point the financial performance need to be verified and calculated so that the performance is being tracked and progress is being accounted. So for that, periodicity is another next principle which is fundamental. So what does the periodicity mean? For every accounting year, we call it as 1 year. For every 12 months, we close the books of accounts, we see how the performance is, and we open the next accounting year with opening balances. So these are the sister principles which are supporting this matching concept. But matching concept is a major principle due to which we are following this, learning this concept of revenue expenditure and capital expenditure. So with this understanding, I would now like to explain you why how this matching principle is being applied in our topic of capital expenditure. Okay, purchase of fixed asset which has an intended use for next 10 years. Okay, so this capital expenditure was incurred in year 1. Okay, in the first year for rupees 10 lakh is being spent for this particular fixed asset. So though it was incurred in the year 1, what do you see in the revenue? Would you like to see the graph? Do you see the graph? Yes, you see an upward graph, right? You see that the revenue is being increasing year on year and there is a upward trend over next 10 years. So that means this, though the expenditure was incurred in year 1, you see the benefit of that expenditure over the next 10 years, you see the benefit of it in the revenue, correct? So based on the matching concept which we understood now, it is always necessary to break this 10 lakhs over the period of 10 years and show it as an expense. It won't be right to expense of the entire capital expenditure in year 1 itself. So you need to match this capital expenditure against the revenue over the benefit. So though it was incurred in the year 1 of rupees 10 lakhs, the benefit you get for next 10 years, you need to match this expenditure against the benefit which you got against the revenue. So even based on, so once again, it is the matching concept due to which you cannot show this 10 lakh as expense in the year 1. You need to show this as expense as 1 lakh over the period of next 10 years. And that's where this distinction between revenue expenditure and capital expenditure comes into picture. So far, I have explained you on what is revenue expenditure and what is capital expenditure, but there would be various factors which you need to consider in order to make a distinction. So I have made things simpler. So these are the factors which you need to consider why you distinguish between revenue and capital expenditure. Number one is the nature of the business. What is the nature of the business? Depending on that, the expenditure is being classified. Okay, let me give you an example. The transaction is the same. The event is the same. Purchase of wood. Okay. So a trader of wood who has purchased wood, for that particular trader, this purchase of wood is nothing but a revenue expenditure because it is a day in and day out operation of the business. He trades in buying and selling of wood. So for a trader, the purchase of wood is a revenue expenditure. So that's why the nature of business is very important. For some other industry, say for a FMCG product, the purchase of wood for making a fixed asset or furniture for their own factory. Okay. Their nature of business is FMCG, so nothing relating to wood. In that case, what happens is the wood is being purchased, but it is being used to make a fixed asset. In that case, what happens? It becomes a capital expenditure because furniture once again is being used has a long-term use. Correct. So the second factor which you need to see is recurring nature of the expenditure. Whether the expenditure is being incurred on a regular basis, on a day in and day out basis, and what is the purpose of the expense. This is once again a very important factor which you need to consider. The intention by which this expense is being incurred. A stockbroker is there. What does that stockbroker do? He acts as an intermediary, basically, buys, sells the stocks on behalf of someone else and he gets the commission, right? So as an intermediary, stockbroker stocks is what is nothing but a inventory. It's like a stock only. Okay. So anything relating to this stockbroking activities would be a revenue expenditure because it's a day in and day out operation. The purpose of expenses also is incurring all the expenditures or purchasing the stocks only as an intermediary on behalf of someone else. Right? However, if the stockbroker himself purchases stocks and the purpose or the intention of incurring this particular expense is for his own investment purpose, he has invested in some stocks, then will he still show it as a revenue expenditure? No. He would be showing it as an investment, which means it is an asset. Capital expenditure. Correct. So purpose of expense is another third factor. Next is the effect of incurring that expense in the revenue generating capacity of the business. So in the previous example which we saw, the 10 lakh which was spent in the year 1 had a benefit of optimizing or increasing the revenue over a period of next 10 years. It has an effect in the revenue generation capacity of the business. So that is also one of the factors to be considered to tell that it's a capital expenditure. Finally, one more, the last concept is materiality, which is very important because whenever there is a mismatch or confusion, it is the materiality of the amount which is being taken into account and call is being taken whether to categorize the particular expense as revenue or capital expenditure. I hope these factors were clear. You need, I have given it in a very short manner on the factors that you need to consider that will help you in easily identifying whether a particular expenditure is a revenue or capital expenditure. I hope in today's session, it was a great value add of this demo session as I have chosen a topic which is so foundational and yet it is very important till the practical application of the topics of the accounting standards in real life in your jobs as well. So any questions, you could put it in the chat box or any feedbacks, most welcome. Thank you.